Yeah, so it
Um,
mess up your setup, right? So
all right, good. Well, I'll go ahead and give you an introduction to all our listeners. Before I do that, are you familiar with the Zoom platform, how
yeah,
you can share
yeah,
the screen down at the bottom?
I am. I am.
Okay, and then we'll have the Q&A and the chat boxes up if you want to open those up if you haven't already. I'm looking at the Q&A box. If you want to leave questions till the end, I can either queue you up or you can just go down through those questions as they come up.
Sure.
And the chat box there, people use that quite a bit. So just make sure you have those up in front of
So
you.
do I answer questions as we go along, or do you want me to wait until the end?
That's up to you. Different people like to do different things, so it's really, whatever your style is.
Okay.
So let me introduce you to our attendees, and we'll let you get started.
Yeah.
So this morning we have with us James Kandasamy, Achieve Investment Group. He is the CEO of Achieve Investment Group LLC. He has over 6 years experience in real estate with more than 4 years in multifamily acquisitions and asset management. James offers clients vertically integrated services in multifamily investment, including finding off-market deals, strong underwriting skills, and construction and property management. His portfolio has 1,300 units and a value of over $100 million. James, thanks for being with us this morning. And any updates to that profile since last time,
No, you captured it correctly. I think I did update my profile, so you got everything correct.
Excellent, excellent. And are you going to be doing a PowerPoint for us this morning?
Yeah, I'm going to share that right now. So at least.
And your time slot is from 11 to 12:15, and then so if you end up doing the questions at the end, we usually leave the 15 minutes at the end there at about 12 to follow up with questions. But if you answer them during the presentation, that's fine as well.
Okay.
So I will, without further ado, I will leave it over to you. I'll mute my mic and shut off my camera, and you'll have full control.
Sure. Are you going to be looking at the Q&A box and chat box, Stacey?
Yeah, in and out. I usually check it because I'm working on a couple other things while you're speaking. So I will monitor it, and if you don't get to anything, I'll follow up.
Yeah, just let me know if I'm not answering. I put my slide deck on a full screen mode, so I'm not sure whether I can see that or not.
Yeah, that's fine. So I'll just then hold the questions till the end, and we'll just do kind of a follow up at the end if that's all right with you. So
Okay.
I'll break back in at about 12 o'clock and follow those up.
Okay.
All right, James, take it away.
All right. Sounds good. Happy to be presenting here about passive investing. But before I go further, I want to make sure I introduce myself because some of you may not know me. Let me just get started. So disclaimer, whatever we're discussing here is confidential, used for providing information, education, and training, right? So we have compiled this presentation from different sources, but it's a lot of it's from my book, right? So we believe to be this information to be reliable. We are not making any representation or warranties to the accuracy and completeness of information contained inside here. Please consult your attorneys, CPAs, financial advisors for any investment decisions. So about us, so we are a vertically integrated team, we primarily do value add execution on multifamily. So there's two of us. One is myself, James Kandasamy, and my wife Shanti. I'm a director of acquisition and investor relationship, and Shanti is director of property management and construction management. We have two big divisions in our company. I used to be a senior manager on an electrical engineering company and also have an MBA, and recently I got my CCIM, which is basically considered part of the black belt of the commercial real estate industry. Right, our total asset under management more than $100 million. We have 1,300 units across 8 large multifamily in Central Texas. And let me clarify about this 1,300. This doesn't include our passive investment or our investment where I'm the KP, right? So I have some passive investment and some KP, but I'm not including that into this 1,300 units. And I will describe why I'm emphasizing on that later on. Total money raised, 25 million. We have raised over 200 unique investors. Expertise, we are vertically integrated functional team. We are also really good at finding off-market deals, and we also do a quick turnaround on a value-add deal. right? So our organization chart, we have three big divisions, and we have almost 30 of our employees working for us right now. We have 4 corporate staffs, and our 3 big divisions are, one is asset management, which is a chief investment group, and a chief properties, which holds the property management. We have like almost 20 something people over here, and side contractors, which we does all our contracting work for our own properties. We have like almost like 8 people over there. So total over 30 people. We are an award-winning team. We won the best San Antonio Property of the Year for best rehab for 2017. Among all the big property management company like Greystone, Capstone, we are the single one who went up on the stage without any team cheering for us. So I was alone there. So it was a very dark and silent moment on that 1,000 people award ceremony. It was a good experience there. Many of you may know about my book, which was launched in February 2019. We the #1 bestseller in US and Canada. Available in 3 versions: Kindle, audiobook, and paperback. So you got no reason not to read it. I'm an audiobook guy. That's why I made sure that I have audiobook on day 1 of release. We have 32 5-star review in Amazon. Many of the people who gave me review doesn't even know me, and I've never met them. So presume it's absolutely genuine. Just for you guys not get to know more about us and how to get access to us, we recently launched a podcast called Achieve Wealth Through Value at Real Estate Investing Podcast. I think we have released like almost 7 to 8 episode up till now. It's not a motivational, or it's not a high level marketing podcast, right? This is advanced topics. If you want to take a pen and a paper and write down on things that you can implement right away, this is the podcast. It usually lasts like an hour. And I think the shortest one I have maybe like 40 minutes. So it's a pretty detailed, and me interviewing some of the commercial real estate operators on how are they doing it. It's not like very high level. So if you want, you can check that out. I'm also the admin for Multifamily Investors Group in Facebook. We have 1,500 members in the past 3 months. We just launched it 3 months ago. And there's a lot of discussions going on over there, high quality discussions. So you want to check that out as well. So this is all our portfolio. As I said, we have like 8 properties across Central Texas. 7 of it is in San Antonio. 1 of it is in Austin. Okay, so let's go into the meat of the discussion, which is passive investing in multifamily, right? I would say passive investing in commercial real estate as well. And I said the insider secrets is because there's a lot of things that you don't get from a lot of presentation, because a lot of points will be based on, from sponsor perspective, right? But I like to really look at from a passive investor perspective, because 95% of the investors are passive, right? So why not talk about them and how they want to be a smarter investor when they choose their investment, right? What is passive investing? So I'm going to go through very high level on introduction. Many of you may already know this, but I think this is good to start on a fundamental. So passive investing, company structure, usually on a syndication, there's one big box on the top, which is GPs called deal sponsors, and the LPs, which is passive investors, right? So the GP roles are finding a property or properties or deals, obtain financing and sign on the loan, raise capital and manage the investment. So, and also the passive investors is very straightforward, provide funding to be part of the equity and receive cash flow. Who can be passive investors? I just want to quickly go through this, even though many of you already know this, but I think it's want to emphasize the basics. There's 2 types of regulation. One is called 506B. Actually, there's many types of regulation, but these are the popular ones. 506B, which emphasizes on pre-existing relationship with sponsors. They have a max unlimited accredited investors, but sophisticated investors are limited to 35, right? And regulation 506C, which is basically only accredited investors and can advertise, right? So 506C just recently was given the go-ahead through the Jobs Act in 2015. So, it used to be 506B alone, where you need to build a lot of relationship, and there's a lot of clubs were created to create that kind of pre-existing relationship. But with 506C coming in, it has disrupted the industry where anybody can advertise, but it's only limited to accredited investors. So there's two types which is still being used and very popular. I primarily use a lot of 506B just because I'm used to it, and I like to build relationship with my passive investors. But 506C will also be a different pro to it when you want to use it. So just a quick recap: sophisticated means you need to have experience and knowledge necessary to weigh the risk and merit of investment opportunity, whereas accredited is more than 1 million net worth without your primary residence or earning 200K or 300K if married in the past 2 years. So whether your spouse is working or not, you need to be earning 300K in the past 2 years whenever you talk about your accredited. And the other quick difference that I need to make sure I mention, 506B is a self-accreditation. That means if the passive investors tick a box, say, I am accredited, nobody's going to check on it. Whereas 506C, it do require the sponsor to do some kind of verification on the accreditation. So there's a lot more paperwork on making sure that you're accredited in 506C, whereas 506B, is self-accreditation by the passive investors itself. So in my point of view, as I mentioned, there's two types of popular regulation, right? 506B and 506C. And it does give you an option nowadays to how and where to get started. For any passive investors out there who just trying to get started or part of one particular circle of group, now you have social media which has Facebook groups. So you can go to biggerpockets.com and open an account and start saying, hey, I'm an accredited investor or I'm a sophisticated investor looking to invest, and you start to get traction over there. And there's a lot of Facebook group out there as well, which allows for introduction of yourself and getting started and just getting me involved, right? So you can start with social media, which is very, very popular nowadays, super easy and less time consuming, and can do it all over the world. The second one I would recommend is meetups. Go to meetup.com and type apartment investing or multifamily investing in your area. A lot of times you will find some, right? So you want to go and start going to meetups. And the key thing when you go to meetup, just try not to just sit there and listen to everybody, right? Whenever you have an introduction, make sure you say that, hey, I'm a passive investor. I would like to connect with the sponsors who are bringing deals, and I would like to be in your list, right? So just make sure you put yourself out there so you start getting deals and getting connected with different sponsors. The other one is local investment clubs. There's a lot of free local investment club in your city. You can go and join them. You can find sponsors through there too. And the other one is paid investment club, which can incur a huge amount of cost to enter. But you can find a lot of people with similar thought process and looking for deals in that paid investment club, right? So, but there's a lot of free way to get started. Social media is the easiest way. Meetups, you can go spend more time and get started from there. Local investment club and paid investment club. So let's go into a bit more deeper, right? So a lot of you may have already started investing, right? Or maybe you already been introduced into different type of investing, but how do you consider deals, right? Whenever somebody sent you a deal, it's important to consider the deal, right? Because right now, as the market has peaked, right, there's a lot of FOMO, right? Fear of missing out. People are worried about missing out, not being in real estate, and all their neighbors and friends are getting rich, right? So, but it's important to look at what are the deals that coming to your table or to you, right? Since you already started networking, assuming you already started networking. So I think the key consideration is type of deals. All deals are not the same, right? You can see many different types of deals that being discussed over there in social media, in Bigger Pockets, or in meetups, or anywhere you go. There's 3 types of deals that I'm going to go through. So the first type of deal is, I would say, core or yield type. You probably would have seen a lot of brokers have what you call advertise their deal as a core plus, right? And usually core plus are deals which is in a really, really good location, in a high growth area, near to big city. And usually it's stabilized, right? It's a very, very stable, it's very high quality type of deal. It's cash flow from day one. And it's very, very focused on cash flow from day one itself, from that investment. But keep in mind, this core yield is a minimum equity appreciation based on the value add for the deal, right? So it maybe the city is appreciating, right, but not the deal, right? You may pick like uh, big city, and that might appreciate, but it may not be the deal, right? So sometimes people buy deals which is categorized as core yield, and suddenly it becomes 300%, 400% return in the 2-3 years, right? But keep in mind, it's not that core yield deal that given you that return. It's actually the city has appreciated, right? So this is what happened in cities like Austin. What else? Where else is there? Orlando. Probably Jacksonville. These are all big cities which is appreciating. The cap rate is compressing very, very fast, including Dallas, right? So some deals which was an average deal or deal that didn't make sense, or deal were making mistake by sponsors, suddenly has become a huge return, not because of the deal or the sponsor, right, but because the city has appreciated. So I would say the core yield, I would categorize under that kind of deal, right? And the second type of deal is basically value add, right? So this is where you have light rehab and operational improvements, right? So where you have management improvement and you have a rehab component to it, where there's some capex to be injected into that deal, right? So going in, the sponsor, no, I have to put in 3,000 to 5,000 per door rehab into this deal to push up the rent, and I have to make sure I have the good management to reduce the expense, right? So this is a value add, right? So a lot of times value add, you will get cash flow after the value add deal has got stabilized, right? I would say it's a more of a medium equity appreciation. Um, it doesn't give you too much of a, I mean, it'll give you cash flow after it got stabilized, but the equity appreciation you will be realizing it only at the back end when the deal gets sold, right? And the last one is basically deep value add or opportunistic, right? So this is basically deals that 50% vacant, right? Or deals that has a 50% burned unit, right? So where it involves a lot of heavy rehab and operational improvements. It's very, very heavy, right? And it may cash flow after 1 to 3 years, right? And but it has high equity appreciation because now you're adding a lot of value into the deal, right? And so these are the three types of deals that you would usually see, right? And sometimes you get a combinational in the gray area in between these, right? But sometimes it's in a good core, in a good area, in a good part of town. It looks like stabilized, but still got value add. So a lot of times the sponsors need to identify, what are they trying to do? What's their business plan when they come to these three types of deal, right? So you want to be aware on where this one fits in because it's going to match what you're going to be putting in. And let's go to key consideration number 2, right? What is best for you, right? So as I said, not all deals are made equal, right? So, and depends on where you are in your investment cycle, right? So I say, don't be FOMO, make sure you matches what you need, right? So people who are later part in their life where they want more stability, they are more at the age of retirement, they want to retire, they want to look more for cash flow investments. So they want to look for more for core yield where the risk is lower, right? Um, I mean, as I mentioned in the previous slide, right, these three types of deal, the core yield is supposed to be lowest risk, whereas value add is medium risk, and deep value add is the highest risk, right? So it's always a risk versus reward equation in any investment, right? So same thing when you come to here, what's best for you, right? So cash flow investors, they want to look for core yield. And when you're young, when you have 20 years or 30 years to retire and you don't have a lot of money, you want to look for equity, right? Or deep value add, right? At the same time, because I mean, the reason why you look for deep value adds because you want to multiply your money. So by the time of retirement, you want to be ready with a lot of cash so that you can move more into core yield, right? And some people who are more on the middle cycle of their investment cycle, they want to look for a combination of equity of cash flow. They can take some risk, but not a lot of risk, right? So it's all based on where you are in your investment cycle. Key consideration number 3, right? Commercial asset classes and market, right? So I know this conference is more of multifamily and I'm a multifamily guy, but I do believe that there are opportunities which is similar to multifamily in all different commercial asset classes. All commercial asset classes as value add component to it. The thing is, you have to find the right operators, right? So I would say, if I'm a passive investor, so I would encourage my passive investors to look at every different asset classes, right? I know there's a lot of buzz about multifamily, and there's a lot of education about multifamily, but there are people who are killing it more than multifamily in other asset classes, right? So the key thing is find the best operators in different asset class. That's the biggest challenge, right? I mean, how do you find the best operators, right? So, and keep in mind, as I mentioned in my book, I mean, there's a lot of data that being presented in my book. This presentation doesn't really represent all the things in my book, but at least it gives you some of the golden nuggets there, right? So asset classes, if you've seen my book, it moves in cycle, right? I did a study of commercial real estate classes movement for 15 years in Austin, and you can see all asset classes moves in cycle. Retail moves in cycles, multifamily moves in cycles, and office moves in cycles, and warehouse, distribution, all moves in cycles, right? So multifamily is not going to be the greatest asset class all the way, right? It's not going to be there. It's going to be ups and downs, right? So even though I would say the risk versus reward on multifamily is much better. I mean, the notion is everybody need a house need a roof to stay on during different market cycle. But as I said, you should definitely check out other asset classes as well to make sure you know what's happening, right? But as I said, the key thing is find the best operator, right? Even on multifamily, if you don't have a good operator, your multifamily investment is not going to do well, right? We'll go through that in a short while. Key consideration number 4, whenever you look at a deal, financing, right? So there's two types of, at very high level, there's two types of financing that you want to be aware. One is called long-term fixed rate, which is basically done by semi-government agencies like Fannie and Freddie Mac. And there's also HUD, right? HUD is for more than 35 to 40 years of kind of loan, and there's CMBS as well. CMBS is more of a, whenever you see a long-term fixed rate on a CMBS, the deal has some hair on it. Most of the sponsors don't go do CMBS unless all the other three didn't give a loan on it, right? So there's always some hair on the deal whenever the sponsor go to CMBS. Second type of loan that you would see is called a short-term loan. So this is bridge loan, conventional bank loans, variable rate loans, and I've done that. I've done conventional bank loans, which is a short-term loan, 2-3 years ago when I was doing deep value add deals, and I don't know, my opinion has been like short-term loans are not suitable at the end of expansion cycle, right? So our expansion cycle is going to be the longest in the history. And in my experience, short-term loans is not going to be suitable at the part of the expansion cycle, just because if you look at 2008, I mean, I didn't invest during 2008, right? We started in 2013 on a single family and moved on to multifamily in 2015. But if you look at a lot of experts or people who have gone through multiple market cycle, the people with short-term loans are the ones that got caught during the downturn in 2008, because there was nobody offering loans, and these bridge loans or short-term loans become expired and nobody give you loans. So even though the deal are cash flowing, you can't really go and refinance, right? So what happened? You have to give it back to the bank, right? So it's just a different type of investment product. However, I want to make sure that I do say that there are some really good operators in turning around short-term loans. So we'll go through operator skill set versus loan in a few slides from now on. So returns, right? So sometimes people say returns is the most important for me, right? And sometimes different sponsors present returns in a different way. So there's 4 types of returns that people talk about. One is cash on cash. Is basically looks at cash flow, right? This is primarily for year 1, right? So the year 2, 3, 4 is all projections on a pro forma, right? And there's something called annual return or AAR, which basically looks at cash flow and also the back end, which is basically when you refinance and sale, right? So there's 3. I mean, before I go a bit more further, so 3 things we're looking at. One is cash flow. The other one is cash flow plus refinance and sale, and this one's cash flow, refinance and sale, and time value of money, right? So let's go back to the metrics. Equity multiple, which is basically looks at cash flow and refinance from sale. And the last one is the IRR, which is basically looks at primarily time value of money and all of it as well. So that's why in commercial real estate, IRR used a lot by sophisticated investors or sophisticated sponsors to look at different types of investments, right? But the easiest and most conservative way to look at any metrics is just look at cash and cash, right? So cash and cash is best indicator for cash flow investors, whereas IRR, I would say best for value add investors and deal comparison, right? So let's say today you're given a development project versus a rehab, a value add, a multifamily project, right? How do you compare, you have, let's say you have 100,000 you want to invest. How do you compare where should I invest? Where would your money make the most ROI, right? So how do you compare you're going to invest in a land development or you want to invest in a multifamily investment, right? So you use IRR because both IRR will look at, by the time the land is being developed, how many years it takes, and when it's going to cash flow, when it's going to sell. It's going to include all that time value of money into IRR metrics. At the same time, it's going to be normalizing the same numbers for the multifamily value add project. So whenever you want to compare, IRR is perfect. But if you just want to look for cash flow and cash on cash, this metric is the best. And there are other advanced indicators which is used by fund and advanced investors. It's called MIRR or capital accumulation. It basically shows how the wealth can be accumulated across different investments. So the other key consideration, which I think is the most important, is the deal sponsor, right? So keep in mind whatever deal that's presented to any passive investors, right? So it's all pro forma, but pro forma is a projection of a deal sponsor, but the sponsor is a constant, right? The sponsor doesn't change, but the pro forma can change. So that's why I say the most important is the deal sponsor because they control the whole deal and how it's going to come up, right? So key thing is look for great operators, right? With 506C, which was introduced in 2015 after the Jobs Act, right? You'll see, the GP side of it. There's many people nowadays. There's like, some deals I've seen, like 6-7 GPs, right? And that's okay. I mean, this GP can be consists of sponsors, sometimes key principals, where you need them to get through the hump of loan, net worth and liquidity. That's basically key principles, and they are money raisers where people who help to raise money. They're supposed to be playing a GP role as well, not just raise money, which is supposed to be part of the GP. They are also sometimes deal finders. Let's say I find you a deal, you give me a cut, right? So there's also part of the GPs, right? So, and sometimes property management as well become part of the GPs, right? Property management company, they take in as part of the GPs as well. The key thing for passive investors is to slice down this GP that you're seeing in front of them. It's a GP sheep, I would call, and slice them down to who are the sponsors, who are the real sponsors. And from the group of sponsors, you want to look for who's the operator, right? Most of the time, this operator is one person, and I've seen maximum 2%, right? Even though there's like 6 people in the GP sheep, the whole deal is controlled by the operator, right? And operator are not people who have property management company, right? Operator are the key people, are the asset managers, or people who have who underwrote the deal, who create the business plan, and they're going to be implementing the business plan. And if you look deep into the deals that you have invested or the deals that come across your table, the operators are not very well known, right? Because most of the time they are busy doing deals, right? So but I think as a passive investors, you need to understand that the operator control the whole outcome of the deal, right? And you have to be able to identify who is that and what is the experience level. Because as I said, they control the whole deal, right? I want to make sure there's no other no questions coming in the chat box. Okay, so there's no questions. So if there's any questions, just let me know. Okay, how do you choose a deal sponsor, right? As I said, deal sponsor track record as an operator is very important, right? I did a survey a few days back on my Facebook group on what are the things you want to look for, and almost 90% of the people participants said that they want to look at the track record of the operator, right? And keep in mind, whenever a sponsor say, I own 3,000 units or 100 million transaction, you want to be very careful on, I'm not saying you want to be very careful. You want to really understand that what are they talking about, right? Are they talking about their experience as an operator on 3,000 units, or their experience as operator on 100 units, but 2,900 of it is passive investment, right? So sometimes it can be a bit misleading, right? So I mean, sponsors, they want to get credibility because they're doing their first deal, even though they've invested a lot of times as passive investor or as a KP, and they want to do first deal. But when they do the raising money part, they go and say, I have 3,000 units, right? But they may not have any experience as an operator, right? And keep in mind, as all of you know, passive investors and active investors skill set are completely different. It's like day and night, right? So it's very important for you to understand how many units or how many what was the experience in their previous deal they've done, right? Before you invest, right? And a lot of times I see people talk about 1 billion in transaction, right? So what, 1 billion transaction as a KP, you can sign on like 10 different loans and you can't claim all of their loan amount or the whole transaction size as your transaction, right? So when you do your first deal, right? So keep in mind, you want to check this out very, very carefully, because I've seen this happening a lot of times whenever I see deals being presented. And it does matter on how many units that you have under asset management as an operator, because that shows that the experience level that you have gone through, right? Second thing you want to look at as an operator is, what's their prior real estate experience? Is this the first time they're doing real estate or not, right? Is that they have done single family or not, right? Have they done large multifamily or not, right? Or have they done only duplexes, right? So what's their prior real estate experience? Do they have a business experience or not? I mean, commercial real estate is a big business, right? They need to have business experience, how to optimize expenses, right? How to optimize capital expenses, how to run a crew of rehab crew, right? Contractors, right? So do they have business experience or not? I mean, sorry to say, not everybody have the business experience, right? Some people come very highly knowledgeable in businesses and they'll do very well in syndication. So you want to make sure that they have some kind of experience, because in the past 9 years, an expansion cycle, everybody has done very well. 95% of sponsors who have make mistakes in the underwriting have done very well as well. But that's not going to go through. That's not going to go ahead throughout different market cycles, right? So I think it's important for you to make sure that the odds are on your side, on a success side, whenever something bad happens. So make sure they have business experience, and also make sure they have leadership experience, right? So a lot of times sponsors or operators have to make a call whenever things don't go right, right? So they should be able to make a call when property management is not doing their job, right? They need to be able to make a call of, firing that property manager and hiring a new one. A lot of people are scared of doing that because there's a lot of work to change property management, right? There's a lot of work to manage investors. There's a lot of work to communicate with investors. So business experience and leadership experience would give that kind of skills for them to handle that whole syndication, right, to success. And the best thing I've seen on how to choose deal sponsor is get referral from current passive investors, right? Because sometimes when a new passive investor, when a new sponsor come and present a deal to you, you do not know how this person is performing, right? And the best way to know about it is not by their nice webinar presentation or the nice colorful slides, is to talk to their current passive investors and try to find who's their passive investor who have invested with them. Talk to them. How did this person communicate? Did they do what they say they're going to do, right? So that's the things that I think is important. That'll give you the best data on how this person going to perform after the deal has been closed, after you invest with them. And the other thing you want to look at, focus, right? Are they doing this full time, right? Or do they have a partner who's doing this full time, right? So it's important that they do this full time. I mean, you're handling passive investors' money. I think it's important for you to put a lot of focus on it, right? So, and some sponsors are focusing more than two asset class, right? So Some people do mobile home parks, 12 stories, they do multifamily, they do everything, I mean, I don't know how they're going to do it, because every single asset class has its own nuances. There's so many nuances in each of the operation that's very important to master that asset class. So just make sure there are no more than 2 asset class that they're focusing on. And competency of the sponsor, right? So are they not just looking at the spreadsheet that is given to them, right? So a lot of times you would have seen that the spreadsheet that's given by the sponsor looks nice, right? The return looks nice. So it's mind blowing when someone say, I really like the return, but you have to understand the return is an Excel spreadsheet, right? It's their projection, right? So, and sometimes people get too way carried over with price per door, right? And somebody is buying 80,000 price per door across the market, and suddenly when a sponsor come with a $40,000 price per door, they say it's a good deal, right? So it's mind-blowing to see that how are you looking at price per door as an indication of how good is the deal, right? Because price per door is controlled by so many things, right? On how big is the size of the unit, how much is the rent, whether it's in the hood. There could be a lot of issues with that 40,000 per door deal, right? Compared to the 80,000 a door deal, which somebody else bringing. And sometimes as a passive investors, you may not know the details, right? So don't go by price per door and don't go by cap rate, right? So it doesn't make sense in a value add deal, right? Unless you're a core or yield type of investor where you want to look at cap rate, which basically determines the cash flow on day one, right? But a lot of times I see a lot of sponsors missed out the user side of it, the tenant side of it, or the demand side of it, right? People talk about the supply. And the demand is, how do they analyze sub-market demographics, right? What is the renter percentage in that area? What is the renters versus owner percentage, right? So sometimes sponsors come to, present a deal and they say, oh, this neighborhood has 130, let's say it has 200,000 average median household income. And they are putting a Class C deal on that neighborhood, and they're so proud of that household income. Keep in mind that you need renters, right? You don't need owners, right? Sometimes people just look at 200,000 median house prices in that area. They are all owners. They are not interested in renting, right? So you want to make sure that they are renters in that market, in that sub market. So sponsors who are looking at this kind of factor, they really know what they're doing, right? So because they can analyze what's the renters percentage, they know the renters versus ownership demand, they can know the median household income, and they can also look at household growth income, right? And also ability to explain their pro forma expansion assumptions, right? Exit cap rate. How do they come up with the exit cap rate? I've seen people blindly put 1% more than what the market is. Where did they get that 1%, right? So, and some people put 0.25 more. Some people put same, right? Some people put 0.5, right? I mean, you can't plug numbers from the air, right? For exit cap rate, and exit cap rate determine a lot on. It's going to skew a lot of your, exit sales price, because if you change 0.25 or 0.5% of your exit cap rate, right? So make sure they're able to articulate what is the growth in that neighborhood or sub-market that justify that exit cap rate. And I don't know, in my mind, whenever people just add 1% more or 2% more or 0.5, blindly without ability to explain, they do not know what they're doing. Are they truly skilled operator, right? I mean, you can see from their past deals whether they're able to turn around certain issues that come during the operation, right? And how they turn around, right? So that's where you see, are they truly skilled operators? And the way to know whether they're truly skilled operator is to ask from their current passive investors. The other thing that you want to look at on deal sponsor is compensation, right? So in general, there's 2 types of popular compensation, even though there's many hybrid of this compensation that's being presented in many different sponsors. But there's 2 types of compensation. One is fee-based structure or waterfall structure, where it comes with preferred returns, right? Where there's initial fees, acquisition fees, or disposition fees and rehab fees. So So a lot of times in this kind of fee-based structures, the sponsors makes money in terms of the fees, right? The acquisition fees, disposition fees, and the EIP. But they do promise a passive preferred return where the returns are prioritized for the passive investors during the operation, right? The second type of compensation that's very popular is equity split structure, where there's a percentage split of profit between passive and sponsors. There's not much of fee based on this equity split structure. Even though there is, it's very minimal, but it focuses a lot on percentage split of profit between passive and sponsors. And it does give some kind of alignment of interest, because if the whole deal makes money, then the sponsor make money. If the whole deal didn't make money, the sponsor may not make money, right? So, but there's pro and cons on both of this structure. There's, in my analysis of both structure, I did a lot of calculation. Both structure gives almost similar returns to the sponsors if it's executed correctly. However, the motivation of keeping a deal cash flowing much higher than the pro forma is given more on the equity split structure, whereas on the fee-based structure, let's say a sponsor promise a 6%, 6 to 8% preferred return on a cash flow, they really don't have any motivation to increase it beyond 6 to 8%, because let's say they promise a 8% return, and that month, that particular quarter, the return comes out like 10%. So let's say it's a 70-30 split. The sponsor is going to get 30% of 2%, right? So 8 minus 10% is 2%. So which is 0.6%, which is really not motivating for the sponsors, right? They rather get the fees rather than the passive cash flow. However, this is just my opinion, but as I said, the motivation factor to increase cash flow during operation is less on a fee-based structure. But the fee-based structure also gives a preferred return, which basically means that passive investors do get a base minimum return, right? Whereas on the equity split structure, let's say the deal doesn't go right, the passive investors may receive much lower return if the deal doesn't go right, or when the economy is not doing very well. The equity split structure is not that good for passive investors, whereas the fee-based structure do have a base return, right? So there's pro and con in both, right? I've been outlining in my book in more detail. So this slide talks about sponsor suitability versus deal type, right? And it's important because I think every deal type, remember I mentioned about 3 types of deals. One is core, the other one's value add, and deep value add. And it does matter on who's the sponsor who's doing each type of deals, right? Some sponsors are really good at core or yield type, and some sponsors are really good at deep value add, right? So it does matter on what is the skill and background of the experience, right? So as I mentioned, type of return, it's more cash flow, whereas the deep value is high equity. Risk of losing money, as I mentioned, is a risk reward function between these 3 types of deal. Core is lower risk. Deep value is high because there's a lot of uncertainties. Overall return on the deep value is much higher, whereas on the core is lower. Acquisition financing also depends, right? On a deep value, a lot of times we want to look at short-term loan because you get high leverage, and there's usually no prepayment penalty when they refinance or when they sell after they turn around. Whereas in the core yield type, most of the time the sponsor will look for agency loans, which has a long-term fixed rate, right? But the bottom 4 part is what I want to look at in a bit more detail, because the type of property management company that's being hired to do these 3 types of deal is important, right? I mean, it's important across all of it, right? But they have to know, like, for example, you have to hire property management who have done deep value add if they want to really do deep value add deal turnaround. Whereas the property management who's doing more of a core yield, they need to be able to experience that kind of tenant demographic, location, and all that. Project management skill is very important on a deep value add. They need to be really strong, because you are turning around a multi-million-dollar deal and there's a lot of moving parts, right? Whereas you don't really need a lot of strong project management skill on a core yield, because a lot of time, as I say, the core yield is a very well located deal, and it's usually cash flow from day one. There's less risk and all that. Well, a risk, it's a relative thing, right? So the next one is rehab capital budget management. This is where I see a lot of sponsor messed up in deep value add, because there's so much of capital movement happening, right? On a deep value add especially. So their capital budget management skill is need to be really, really strong, right? Especially when there's a draw involved with the bank that need to be taken out during the process of capital rehab. So I have a few questions here, so I'm getting a bit distracted. So let me answer that question in a short while. So let me finish this slide. So a capital budget management skill. So you want to make sure that whoever you are looking at as a sponsoring matches with the deal type, right? Because I've seen many times that sponsors who have done core yield type and suddenly they want to do deep value add or value add, and they messed up a lot just because it's a different skill, right? As I said, there's active versus passive investors skill level difference, and even within the active sponsors, there's different types of deal have different skills, right? So the last one is contractor management and scope of work management skill, right? How do they do? I mean, this is similar to contractor and project management, but I think it's important to make sure that I mentioned here, contractor management is huge, and especially on deep value add, they really, really need to know, because they're turning around a large demographic shift, and you're doing a large capex. So let me answer this question. Let me see what's the question is. So as a passive investor, is the deal structure negotiable, rate of return split? No, most of the time, no, unless you're bringing the whole entire capital stack. So for example, most of the time the deal structure, it's presented by the sponsor, right? So you can choose as a passive investor whether you want to invest in that deal or you do not want to invest, right? So it's really up to you. But I have seen like professional passive investors where they say, hey, I'm going to bring your entire capital equity, right? I'm going to bring a whole equity stack for you. You just deal with me. Now I can negotiate my compensation, right? So companies like Realty Share, right? There are groups out there which does that, right? They come in a group and they look for sponsors who need like one person to talk to, and they negotiate with that sponsor. They say, we're going to bring the entire capital stack, but we want to negotiate with you some of the terms. So if you do that, then you can negotiate. Otherwise, if you are just one passive investors who trying to be a small passive investor in that deal, it's not negotiable, right? Second is, Ruben has a question on the equity-based structure. How do you feel 80-20 split? LPGP, quite few of those. I can't help but wonder where the GP is earning enough to make the manage during the whole period. So on an 80-20 split is a different split than compared to the 70-30 in the pref return split. So you have to understand the 80-20 split, when we talk about equity split structure, is a split of the profit. Whereas 80-20 split, the same split on a waterfall model is different, right? The same split is on the excess of the preferred return. So let's say you are doing you're getting a 10% return and 8% is what's being promised. So it's the on an 80-20 is 20% of that 2%, right? So it's a different split. So sponsors do make money on 80-20 split because the whole profit is being splitted versus the excess of it in the preferred return. And there are also asset management fee, and there's also and if they do property management, there's property management fee as well. But property management fee is a common thing across all deals, right? You have to pay some company to do that. But the sponsors do make money even on the 80-20 split, right? Especially if there's a refinance as well, right? Because refinance profits being split as well. So hope I answered that question. Let me see whether is there any other questions on the chat box. Okay, there are some questions in the chat. What if I, as a passive investor, want my capital back after 2 or 3 years? So this happened to me even after 6 months. Somebody wanted their money back, and usually the LLC agreement would allow you to share your shares to your own group. I mean, usually the LLC or the company agreement gives opportunity for first. So usually this is how the layer works. So the first is whether the sponsor can buy the share of that passive investor who want to get out. Second is the sponsor can call a meeting within the current LLC members and say that this particular member want to sell their shares. Anybody want to buy? And if nobody buys, then now the sponsor can go out and sell their share to any public, right? So they can do, there's 3 levels of operation that they want to, they can do it in terms of selling their shares. And selling their shares will be based on the value of that share of that point of time. So you can always get out of the deal even after year 2 or 3, right? It's not fluid as the stock market, right? Hope I answered that 2 questions, and keep that questions coming. So I'm done with the presentation, but I want to make sure that you guys go and get my book, which is the only book right now focusing solely on passive investor perspective, right? So we have like 32 5-star review. As I mentioned, we have 3 different types of format, and the book has a lot more information, a lot more data, a lot more points and golden nuggets that I did not cover here. It's too much to cover on a 1-hour presentation, but you should definitely, it's just $15 for physical book. I believe Kindle is $9.99, and you also have an Audible, which is like, 14 something dollars. And if any of you want to be in our passive investor list, just go to our Achieve Investment Group. There's a link called Invest With Us. You fill up the form and set up some time on my calendar to chat. As I said, I like to have a relationship with my investors. So set up some time on my calendar to chat, and let's start building that relationship. And the last thing is, Shanti and I are excited to announce that we'll be announcing our own unique mentoring program in the next few months, where you can learn A to Z from the real operators. There's just not many multifamily education out there which is done by real operators. Sometimes people teach you asset management, sometimes people teach you capital raising, sometimes, but what we are going to do, we're going to do asset management, capital raising, property management, construction, everything from A to Z. It's a slow process, right? If you want to learn it right, you want to learn the whole thing, and you make a lot more money when you learn the whole thing, right? And just email me, James at achieveinvestmentgroup.com to get early notice. Thank you. I think we have come to a Q&A session.
Thanks, James. Did you go over, I saw you answer some questions out of the chat box. There's 2 questions in the Q&A box. Did you go over those yet?
Yeah, I did that too. Yes, correct.
Okay, all right, excellent. I'm going to queue these up, and be sure and submit any questions to the Q&A box while we have a few minutes left here with James. James, I like the idea of vertical integration, kind of the way you do things all the way through. I know a lot of us do, because we like things done right, and there's no better way to do them right than do them yourself. But that can lead sometimes to deflection from focus, or lack of focus. What do you do to balance that out?
Well, I think when you talk about lack of focus, I think lack of focus on acquisition, right? So that's true. From what I see, from what I know in terms of returns that we're giving to our investors, we are one of the best operators out there, but we are not buying 3,000 or 5,000 units, because we also own the property management company, which means whenever we buy, we focus on stabilizing the deal rather than keep on buying, right? But keep in mind, right now we are at the last stage of expansion cycle. There's not many deals out there anyway, right? So even though you're buying deals, there's just not many good deals out there, right? So I rather set up correctly right now, and when the market turns, I can take advantage of the whole pipeline by learning the whole thing, right? So, but you are right, it's going to derail you from acquiring a lot of units. But as I said, there's just not many good deals out there right now anyway, right?
Yeah, no, definitely. There's plenty of deal flow, but the underwriting doesn't look too good.
Yeah, most of the deals are not real deals, right? Anybody can sell anything, right? But whether you're buying it at the price that you make sense or not, right? It's important.
And so on the property management piece, kind of walk me through how you came to the decision to do that? Because usually vertical integration comes as, well, from what I've seen, it comes as kind of like a reaction to a reality instead of something planned ahead of time. So, or was that the case with you? Did you start going into it planning to do everything vertically integrated, or did you make a decision after you ran into some issues with other property managers?
We decided from day one to do our own property management, just because every time we look at a P&L of some other property management company, we feel so frustrated because a lot of things are not done right. And we can never find a good property management company that does like what we do. And also we feel very obligated because we are taking money of passive investors and we want to turn around quickly, right? And whenever you have that middleman in between, which you got no control, you are like slowed down by many factors, right? So we decided, okay, we're going to own the entire pipeline. We're going to turn around things quickly. And since we do a lot of value add, we think that's important for us, because value add need a lot of attention, and just not many property management company out there who knows how to do value add. And the one thing I want to mention, very important, is not everybody can do property management, right? You need certain skills to do it, right? I don't have that skills, but my wife do, right? So she's really good at property management and construction management. I'm really good at underwriting, finding deals and, working with investors. So you need to find that person who are really, really good at operation. So as I say, even though it's nice to say everybody should have a vertically integrated, but you have to find that person who has that operational experience and build up that property management skill.
Yeah, and on the property management side, you talked about, it's so hard. They're P&Ls, and what we always talk about is the fact that all that I've seen, property management companies are not incentivized to save money because their fee is based off of gross rents, not on.
It's a flawed model.
Yeah,
it's a flawed model, right? Because they are 3 to 4% is based on income, not based on NOI, and we want NOI.
Right, exactly, and we've floated some structures out there to a couple of companies, and not always the best response.
Nobody will agree to you. I've tried that. We hired a consultant to build up our. In the beginning, right, we hired some consultant to put in some process in our property management company. And I asked him, hey, why are we doing this? Why not we change it to NOI-based model? And he said, nope, nobody will agree to it. We do not know how to do it, right? Because NOI changes, right? You have property taxes changes, you have insurance change, and it's out of their control, right? So they rather just focus on income, which is easier to control.
Yeah, and they, and then a lot of companies will come in and say, this is our fee with this much minimum. So that way, that's the other structure, is put an NOI structure in place with a minimum floor, but again, it's that's the way we've always done it mentality. Well, this is just how we do it. So, and I understand your mentality or your movement or desire to manage your own.
Yeah, it's hard even for property management company, right? I mean, how do they consistently make money? It's a business of problems, right? Property management, right? It's a lot of HR issues, a lot of city issues, a lot of issues, right? And they don't make a lot of money. I'm not sure how are they making money, right? Other than if they use like some of their corporate staff across the whole portfolio, right? They have like a regional manager, construction manager across 20 different properties, right? Then they can make money, because now their common corporate staff is only like very small amount, right? But they get a lot of percentage. But that's gonna devalue their quality of attention that they give to each property.
And I guess, how do you weigh the pros and cons of vertical integration and necessary infrastructure for vertical integration? So, you can do everything yourself, but you need a lot more in place than if you're subcontracting it out. So there's always that pro and con, that give and take of that.
Yeah, it's hard in the beginning because it's hard to get an operation manual up. It's hard to train people. It's hard to implement process, especially when you're starting from beginning compared to, since you already have like 1,000 or 3,000 units, right? So it's hard, but it's doable. But I think you can do it whenever you start up. You learn a lot more in terms of the whole multifamily operation. And I think seriously, I think you make the most money in operation rather than, not say as a sponsor, I'm saying for the whole investment, the most money is made in the operation because there's so many knobs that you can turn. You can optimize a lot of parameters to get the best returns for your investors, right? Versus giving it to third-party property management.
Right. Yeah. Small things like consolidating dumpsters or different things like that add to the NOI, which, then divided by cap rate, equals a huge valuation that most people don't even consider. And so the property management company is like, oh, it's only $60 extra a month. Well, that's a huge valuation add if I cut that out, or, as an expense. So yeah,
Absolutely.
I totally get
And
it.
also, like when things are not going well, or when things are going well, if you want to reduce the staff, you can't do that in a third-party property management, right? You can't ask them why you didn't respond to this many phone calls, right? You can't do that in a third-party property management. It's up to them, right? So I would say optimization of investment returns are much more efficient when you have your own property management companies.
Yeah, definitely. I agree. Well, James, thanks for being with us. I do have one other question here. It says, as a new person in this whole process, how would you say is the best way to convince an investor to trust me? What's the best way to start getting investors is the question.
I think the best way is to build your track record, right? So even when we started with single family, right? So we did it on our own and we learned the entire process, how to do contractor management, how to do rehab management, how to buy, right? So once we have all that skills, we start telling people, right? Hey, we did this on a single family. We did this on a single family. We made this much of money. Then people think, that itself is a credibility even on a single family because you know how to buy real estate right. You know how to do construction right? So once you have that kind of track record, you can basically, create a pitch deck and tell people, this is my experience in real estate. I'm trying to buy something for the first time in multifamily, and I believe I can do this. That's where your track record comes. The other way they can do it is you just get a mentor or partner who have done this before and tag along with them, right? Or even be a capital raiser, right? But I think the key thing, the food of the chain, the top of the food chain is basically being an operator. Be the guy who does the whole thing, right? That's where you make the most money, you get the most experience, and you will survive through the whole real estate cycle, right? So I say there's a lot of people who are a champ in a bull market, right? I may be one of them, but we did learn a lot of details on them as well, on each part of the operation.
Yeah, and you're exactly right on making the most money because each one of the people that you hire is making a profit. Like if you hire a general contractor, he's making a 20% markup. Exactly. The subcontractor's marking it up 20% on his costs. So you've got 20% and then 20%, and then it's passing on to you, and then that's expense. So if you're able to consolidate that, then that's cash flow to you. And you're saying how property managers don't make money unless they spread it out over many deals. Well, you're already making money off the deal. It's cash flowing. So it's just a cherry on top, really.
Yeah, they make money in a lot of things, right? For example, let me tell you one thing that I really, really find it fascinating, right? On advertising for apartment, right? So usually any property management company, they'll advertise on Zillow, they'll advertise on Apartment Guide, they'll advertise on apartment.com, they'll advertise on where else? Zumper. There's like 4 or 5 different advertisements they advertise by default to everybody, right? But nobody looks at how effective of each of these advertisements, right? So, but in my property management company, I do advertise all of that, but only for 3 months. So at the end of 3 months, I'm going to look at who's the most effective, right? It's always the 80-20 rule, right? And each of these advertisement is $600 a month, right? You go to Zillow is $500. You go to apartment.com is $700, right? Apartment Guides. So every month you have $2,400 by default whenever you go to third-party property management company. But in my property management company, I have the same amount, but only for 3 months. At the end of 3 months or 6 months, I already have all the data on who's the most effective, right? And I just choose one. And I say, this is the most effective guy. I'm going to do $600. So imagine the amount of $600 versus $2,400. So that's a difference of what? How much? $1,800? Divide cap rate per year. That's a lot of difference, right? In terms of return, right? So one example of that, right? There's a lot of other profit centers as well across contractors buying appliances. And there's a lot of profit center for property management company, which is hard if you don't have your own property management company and you do not know.
Definitely. I totally agree. And let's see. I was looking at the Q&A. Just somebody says, "Excellent presentation. You just cut all the BS and cut the clutter." I love it. That was a
Yeah,
compliment.
multifamily is not an easy asset class to manage, right? I mean, right now it seems to be easy because a lot of people are making money, but everybody also forgot that we are on a boom market, right? Even you make mistakes, you still make 200%, right? And some people say I made 300% last month. Hey, actually, you should have made 400% because the market went up by 400%, right?
Yeah.
Why did you make only 300%?
Right. Right.
Right. So
All relative.
the market factor has hidden a lot of people's incompetency, but it's nothing wrong. I mean, as I said, it's a good thing for everybody. Everybody makes money, but when the market turns, I think the real operators who knows the real stuff from ground up is the one who's going to survive.
Excellent. Excellent advice. And James, thanks for being with us today. Our time is about up. We're going to give everybody a couple minutes break for lunch. And thanks again for joining us. And everybody, please reach out to James with any questions and look for his coaching platform that's coming out pretty soon. And James, thanks again.
Awesome. Thank you very much, guys. Bye.
Bye. All right, everyone. Thanks again for joining us for that session. We are getting ready to take a short little lunch break. We have coming up at 12:30 in room number 1, we have a panel discussion. Those are always a lot of fun. Unique financing strategies. So there's a lot involved in that. So we have some great speakers. Anton Matali, Mark Vanitsky, and Ryan Duff are all going to be on that panel, so be sure to tune into room 1. Of course, room 2, I'm a little partial to, so we have some great speakers coming up. We have Craig Haskell coming up next, the 8-step process to raising money to fund your deals. So no matter who you are, if you're doing multifamily syndication, you will have to raise money, so check out Craig Haskell's presentation. And in room 3, entrepreneurial habits for success with Ivan Barrett. And so check that out in room 3. And don't forget to register for our iPad giveaway. We have 3 of these. Dan was just holding it up in the other room. Let's see if we can see Dan over there. There's Dan. Oh, and I saw Danny on the couch. He's chilling. What? I'm the only one working here. Anyway, so be sure to register. You can go to nextmfin.com and get an entry that way. Go to the podcast, Multifamily Investor Nation podcast, post a review, send a screenshot to Stacy, that's Stacey, Stacy at multifamilyinvestornation.com, and then be sure you participate as much as possible. Go to all the rooms, participate in everything that's going on here, and you'll get more entry you get. So again, we'll see you back here at 12:30, and enjoy the short break.